From the interest on your car loan to the price of your groceries, does it ever feel like you're losing financial control? What if I told you that a lot of those pressures trace back to a single, unelected group of people in Washington, D.C.? This is the story of how the Federal Reserve controls every dollar you make. Have you ever stared at mortgage rates and just thought, why does this one number have so much power over my life? You're not wrong to feel that way. We hear people say, the Fed raised rates, so mortgages go up. But that's not really how it works. The truth is way more complex, more powerful, and it touches every single corner of your financial world. Today we're pulling back the curtain on this institution. And we're not talking about abstract economic theory, we're talking about the direct line from their decisions to the money in your pocket, the cost of your debt, and even the security of your job. Stick with me, and by the end of this, you'll understand the hidden financial game being played all around you, and you'll have the knowledge to navigate it. The reveal: introducing the puppet master. So who's really pulling the strings of the U.S. economy? While politicians and CEOs grab the headlines, the most powerful player often works in the background. Meet the Federal Reserve, or as you know it, the Fed. Created by Congress back in 1913, its original mission was to stop the brutal bank panics that kept crippling the country. Think of it as a firefighter for the entire financial system. On paper, its duties sound pretty reassuring. Keep an eye on the nation's banks, maintain the stability of the system, and handle banking for the U.S. government. But its most powerful job, the one that affects all of us, is running the nation's monetary policy. And this isn't some dusty academic concept. Monetary policy is just the fancy term for how the Fed influences the amount of money and credit sloshing around in the economy. It's all about making money cheaper or more expensive to borrow. In doing all this, the Fed is wrestling with a dual mandate from Congress: aim for maximum employment while keeping prices stable. Simply put, their job is to help as many people as possible have jobs without letting inflation run wild. They're always aiming for that sweet spot, an inflation rate of about 2%. It's a massive balancing act. To pull it off, the Fed has a small but incredibly powerful toolkit. Understanding these tools is the first step to understanding your own financial life. They have two main levers of power, one that gets all the media attention and another that's arguably even more powerful, but way less understood. Let's start with the big one. Section 1, Decoding the Toolkit, the big lever, the Fed funds rate. The tool you always hear about is the federal funds rate. Ever heard a news anchor say the Fed is expected to raise rates by a quarter point? That's what they're talking about. The federal funds rate is the interest rate banks charge each other to borrow money overnight. It's the absolute bedrock interest rate for the entire financial system. Think of it like the master volume knob for the cost of money in the whole country. When the Fed turns this knob up, borrowing gets more expensive for everyone, from the biggest corporations all the way down to you. When they turn it down, borrowing gets cheaper. Now, the Fed doesn't just shout a number into the void and hope it sticks. It uses a clever system to steer the rate where it wants it. Its main tool for this is called Interest on Reserve Balances, IORB. Big banks have to park a certain amount of cash at the Fed, and the Fed pays them interest on it. This IORB rate acts like a powerful magnet. Why would a bank lend money to another bank for less than it could get, risk-free from the Fed itself? It wouldn't. So the IORB basically sets a floor on rates. To create a floor and a ceiling, the Fed uses two other rates. It has the Overnight Reverse Repurchase Agreement, ONRRP rate, which it offers to even more financial players, creating a hard floor for short-term rates. At the top, there's the discount rate, which is what banks have to pay if they need to borrow directly from the Fed in an emergency. This acts as a ceiling, because why would a bank borrow from another bank at a higher rate than what the Fed itself is offering? By tweaking these three rates, the Federal Open Market Committee, the FOMC, which meets about 8 times a year to make these calls, can guide the federal funds rate exactly where it wants it to go. So the Fed sets the price for banks to borrow from each other. But how does that actually affect you and the rate on your car loan? That's where the ripple effect starts. But before we get there, let's look at the Fed's other, more mysterious tool, the one people call the money printer. Section 2, Decoding the Toolkit, the money printer, quantitative easing, and open market operations. If the Fed funds rate is the master volume knob, then quantitative easing, or QE, is like flooding the studio with sound from every direction. QE is a powerful and pretty controversial tool the Fed breaks out when just cutting the main interest rate to zero isn't enough to get the economy going. Quantitative easing sounds super complicated, but the idea is actually pretty simple. It's when the Fed buys financial assets, usually government bonds and mortgage-backed securities, from the open market. And when the Fed buys these from a bank, it doesn't pay with stacks of cash. It just electronically credits the bank's account at the Fed. Poof! New money is created out of thin air and pushed into the banking system. The goal here is to flood the market with cash and liquidity. With all this extra money on hand, banks are encouraged to lend more and at lower rates. This whole process is a type of open market operation, which is just the general term for the Fed buying and selling securities to manage the money supply. Picture it like this. The Fed wades into the bond market and starts buying up tons and tons of bonds. This huge new demand pushes the price of those bonds up. Here's a basic rule of bonds. When their price goes up, their yield, or the interest rate they pay, goes down. And since the yields on government bonds are the benchmark for tons of other loans, this directly pushes down the cost of long-term borrowing for things like mortgages and big corporate loans. QE became a household name after the 2008 financial crisis, and the Fed fired it up again in a massive way during the COVID-19 pandemic when it needed more firepower to fight off a recession. Of course, what the Fed creates, it can also take away. The opposite of QE is called quantitative tightening, or QT. This is when the Fed does the reverse. It either sells the assets it owns or just lets them expire without reinvesting the money. This sucks money out of the financial system. Less money sloshing around means borrowing gets tighter and more expensive. So now we see the Fed's two main weapons: the federal funds rate controlling the short-term cost of money, and QE controlling the long-term cost and availability of it. Now let's finally connect the dots from the Fed's boardroom right into your bank account. Section 3, the ripple effect, how the Fed hits your wallet. Part 1, debt and savings. This is where all that economic theory becomes your personal reality. The Fed's decisions create a powerful ripple that shapes nearly every major financial move you make. Let's start with the big one for most people, your mortgage. Ever wonder why mortgage rates can shoot up even when the Fed hasn't officially touched its key interest rate? That's because the Fed doesn't directly set your 30-year fixed mortgage rate. Instead, fixed mortgage rates tend to move with the yield on the 10-year Treasury note, a bond sold by the U.S. government. Lenders use the yield on the super-safe bond as a benchmark to price their long-term loans. So how does the Fed influence it? Through signals and expectations. The bond market is always looking ahead. When Fed officials even start talking about hiking rates to fight inflation, investors predict that returns on short-term cash will soon be higher. They start selling their longer-term bonds like the 10-year Treasury to get ready. This wave of selling pushes the price of the 10-year Treasury down, which causes its yield to go up. And as that 10-year yield rises, mortgage rates get pulled right up with it. That's why mortgage rates can jump weeks or even months before the Fed makes an official announcement. The market is just reacting to the smoke signals. And it works in reverse. In the first half of 2024, mortgage rates actually fell even though the Fed hadn't cut its main rate. Why? Because the market was already pricing in the expectation of future rate cuts. Okay, what about credit cards and auto loans? This connection is much more direct. The interest rates on these loans are usually tied to the prime rate. The prime rate is what banks charge their best, most creditworthy corporate clients. And it moves in near-perfect lockstep with the federal funds rate. When the Fed raises its rate by 0.25%, the prime rate usually jumps by 0.25% within a day or two. If you have a credit card with a variable rate, your APR is probably calculated as prime rate plus a margin. So when the Fed hikes rates, your credit card debt gets more expensive almost immediately. The same goes for home equity lines of credit, HELOCs, and most new car loans. A seemingly small 1% rate hike on a $30,000 car loan can cost you hundreds, if not thousands more over the life of the loan. Finally, what about the money you're trying to save? The Fed's moves also hit your savings accounts, money market accounts, and CDs. When the Fed raises rates, the interest you earn on your savings should go up. On the flip side, when the Fed raises interest rates to fight inflation, it is deliberately trying to tap the brakes on the economy. Borrowing gets expensive, so businesses pause their expansion plans. That construction company waits on the new equipment. The tech startup tightens its belt. This leads to a hiring slowdown and, in some cases, layoffs. This is the painful trade-off the Fed constantly faces. Cooling down an overheating economy often means causing some pain in the job market. Next up, your investment portfolio, especially the stock market. There's a famous saying on Wall Street, "Don't fight the Fed." It means that when the Fed is pumping money into the system and keeping rates low, it's like a powerful tailwind for stock prices. This works for two big reasons. First, low rates make it cheaper for companies to borrow and grow their profits, making their stock look more attractive. Second, when safe investments like bonds are paying almost nothing, investors are forced to look for better returns in riskier places like stocks. This flood of money into the stock market pushes prices up. When the Fed raises rates and starts QT, the opposite happens. Suddenly, those safe government bonds are offering a decent return, making them a real alternative to risky stocks. At the same time, higher borrowing costs can squeeze company profits. That combination can be a major headwind for the market. A lot of the stock market's wild swings are just investors trying to guess what the Fed is going to do next. Finally, and maybe most importantly, the Fed's policies directly impact the value of your dollar, which is just another way of saying inflation. This is the stable prices part of their job. When the Fed keeps rates low and does a lot of QE, it's making money cheap and plentiful. That encourages a ton of spending and borrowing. When everyone wants to buy stuff but there isn't enough stuff to go around, prices rise. That's inflation. Your dollar today buys less than it did yesterday. To fight it, the Fed uses its bluntest tool, high interest rates. By making borrowing more expensive, it cools down spending, cuts demand, and gives supply a chance to catch up. This is the tough medicine the economy has to take to get prices under control. The dream is to pull off a soft landing, slowing inflation without causing a huge recession, but it's an incredibly difficult needle to thread. Section 5. The bigger picture. Why does the Fed do all this? So why does this one institution have so much power to steer the economy? It all comes back to that dual mandate Congress gave them in 1977. Their two main goals are to promote maximum employment and stable prices. A third, often forgotten goal is to keep long-term interest rates moderate. Think of the economy as a car. The Fed's job is to be the driver, using the gas pedal, lowering rates, QE, and the brake, raising rates, QT, to keep the car moving at a steady, safe speed. If they floor the gas pedal for too long, the engine overheats. In economic terms, that's runaway inflation. Too much money is chasing too few goods, and the value of your money just evaporates. That's what happened in the 1970s, which was this awful period of stagflation with high inflation and high unemployment that led Congress to give the Fed this specific dual mandate. But if they slam on the brakes too hard, the car stalls. That's a recession. The economy shrinks, and people lose their jobs. So the Fed is always searching for the Goldilocks zone, an economy that's not too hot, not too cold. An economy where most people who want a job can find one and where prices are rising slowly and predictably. That 2% inflation target isn't random, it's seen as a buffer against deflation, a dangerous downward spiral of falling prices that can be even worse for an economy than inflation. This whole setup was born from crisis. Before the Fed was created in 1913, the U.S. financial system was a mess. The Panic of 1907 was the last straw. Everyone agreed the country needed a central bank to manage the money supply and act as a lender of last resort to stop banks from collapsing. Over the last century, its job has evolved from a simple financial firefighter to the main manager of the entire U.S. economy. It's a job that requires a constant, delicate balancing act, with the financial well-being of hundreds of millions of people hanging in the balance. Section 6. The Modern Fed and Today's Economy. So what has the Fed been up to lately, and what does it mean for you right now in early 2026? After a historic campaign of aggressive rate hikes in 2022 and 2023 to crush the highest inflation in 40 years, the Fed has shifted gears. They saw the job market was cooling off a bit and inflation was finally heading in the right direction, so they began cutting rates, with 3 consecutive cuts in late 2025. As of the start of 2026, the Fed has hit the pause button on that cutting cycle, holding the federal funds rate steady in a range of 3.5% to 3.75%. According to Fed Chair Jerome Powell, the U.S. economy came into 2026 on solid ground, and the current interest rate level is meant to balance both of the Fed's goals. But the path forward is anything but certain. Fed officials keep saying they are data dependent, meaning they're glued to the incoming reports on jobs and inflation before they make their next move. While inflation is way better, it's still a bit stubborn and policymakers are watching it like a hawk. Economic growth has been surprisingly strong thanks to healthy consumer spending and business investment, especially in hot areas like AI. The Fed is also juggling new problems. For example, recent tariff policies are seen as a risk that could push inflation back up. And with interest rates being higher, the interest payments on the massive U.S. national debt have skyrocketed, creating political pressures that can make the Fed's job even harder. Right now, Wall Street is in a constant guessing game about the Fed's next move. While the Fed itself has hinted at maybe only one more quarter-point cut in 2026, some investors are betting on more cuts later in the year. This tug-of-war between what the Fed says and what the market expects is what creates a lot of the volatility you see in stocks and bonds. For you, this means we're in a period of watchful waiting. The painful rate hikes are over, but the era of ultra-cheap money isn't back. The current environment is designed to be tight enough to keep inflation down, but not so tight that it chokes off the economy. Understanding this is the key to making smart financial decisions today. Conclusion. The takeaway: empowerment through understanding. So, after all that, what's the big takeaway? The Federal Reserve isn't some shadowy conspiracy. It's a complex and powerful institution that's been given an unbelievably difficult job by Congress. Steer the world's largest economy between the disaster of high unemployment and the chaos of high inflation. To do it, they use their two main tools: the federal funds rate, which is the master control for the cost of borrowing, and quantitative easing, their way of pumping or draining huge amounts of money from the system. The decisions made in that DC conference room create undeniable ripple effects that you feel every day. They influence the mortgage rate you pay, making it easier or harder to buy a home. They change the APR on your credit card, they impact the health of the job market and your career, they're a huge driver of the stock market and your retirement accounts. And they are the primary force fighting to control the price of everything you buy. You can't control the Fed, you don't get a vote on interest rates, and it can be frustrating to feel like your financial life is being shaped by forces so far outside your control. But you are not powerless. The solution isn't to fight the Fed, it's to understand it. Understanding how this system works is its own form of financial power. It turns you from a passive passenger into an informed navigator. When you hear the Fed is signaling rate hikes, you'll know why your mortgage lender is telling you rates might rise. When you see QE in the news, you'll understand the potential impact on your investments and the long-term risk of inflation. When you understand the dual mandate, you'll know why the Fed is sometimes willing to slow down the economy to bring down crippling prices. This knowledge helps you anticipate, plan, and make smarter decisions. It helps you decide when to refinance, how to think about your investments, and why it's so important to have a solid financial plan to ride out the economic cycles the Fed helps create. You've now learned the rules of the financial game. You've seen the person behind the curtain and you understand how the strings are pulled. CTA. This is the kind of financial knowledge that can really change how you see the world. If you found this breakdown helpful and want to keep demystifying the complex world of money, make sure you like this video and subscribe to the channel for more. And now I want to hear from you. What's the biggest way you felt the Fed's impact on your own finances? Was it a shocking mortgage rate? A credit card APR that jumped overnight? Or just the price of your weekly groceries? Let me know down in the comments. Let's talk about it.